So your IFA is destroying your pension, or so is your wealth manager, and they're saying to you, oh, you've got to diversify. That's why we do it. So let's look at some of the funds and how they've actually been wrecking your pension. So let's diversify, shall we? Of course, the best way to do that, they will argue, is, well, why put you in a load of funds? And each fund has, say, 50 to 100 stocks. So I've picked a bunch for you based on name recognition, geography, themes, as well. Invesco, Mortgage Capital, Schroders, everyone's heard of, Capital, Global Innovation, Bailey Gifford, US Growth, look, growth and US, what could go wrong? Scottish Mortgage Investment Trust, well-known name recognition there. Bailey Gifford, European Growth. So we're not just looking at US, we're not just looking at UK, and we're going for growth. Aberdeen, UK, smaller companies growth. So we've gone for UK, Europe, US, global. Schroders, British Opportunities. BlackRock, Greater Europe Investment Trust. Aberdeen, Property. So we've gone for a different sector now. Property. And Aberdeen, China Investment Company as well. So we've gone right out there, China. Right? So how did they do? Lots of diversification. 2022. Oh, okay, that's a bit weird. Down 54, down 53, down 52, minus 46%, minus 42, minus 10. Now, the reason I wanted to pick all of these is because sometimes IFAs message me back and they say, well, you won't put all your money in any one of them. You diversify amongst the diversified funds by having lots of diversified funds. Well, I've done that, and that's going to give me what, minus 40% return in a year on my pension? Okay, maybe it was wrong to go for UK, US, China, Europe. Where the hell else do you want me to go? Maybe it was wrong to go for things with words like growth, innovation, opportunities, trust. Okay, maybe I'm being unfair. 2022 was a rotten year for the market. Actually, you want diversification the most when the markets are falling, because when they're rising, you don't need diversification. You actually want concentration because they're bloody rising. You need diversification the most when the markets are falling in a year like 2022. Well, it looks like you don't get it just when you need it the most. I wrote about this in my Financial Times columns many moons ago, and in some of those books you can see over my shoulder, all 18 of them actually, to show it doesn't work. Okay, I'll explain to you why. So let's pick 2023. The NASDAQ went up a whopping 55%. So surely these knocked the ball out of the park. Oh, no. Okay, Invesco Mortgage Capital was still down another 33% that year. Schroders Capital, Global Innovation. Global, bloody hell, there doesn't seem to be much innovation happening globally then. Down 5. Well, Bailey Gifford, US Growth Trust was up 22 whopping percent. Obviously, well below the market. US growth, where's US growth? Well, you would have thought bloody NASDAQ, wouldn't you geniuses, but it isn't. It was down 52, then up 22. So it's still down over 2 years. Great. Scottish Mortgage Investment Trust up 12%. Remember, that had wrecked your pension by 46% the year before. So that's not done much to recover it. Bailey Gifford European Growth up 7%. A bit more than my bank account, but not much. UK Smaller Growth Trust, well, they managed 2 negative years in a row. Well done. Schroder British Opportunities Trust up 9. BlackRock Greater Europe Investment Trust, woohoo, up 20%. Oh, actually, the year before it was down 32, so it's still down over 2 bloody years, despite having one of the biggest bull markets in history since 1945. Aberdeen Property Income Trust down 23 and then down 15. Aberdeen China Investment down 23, following on from another down 23. Well done. 2 23s in a row. You geniuses. So why is this? I mean, they're diversified by region. They're diversified by style, i.e. you've got growth. You've got... they're diversified by the themes. Property sector, for instance, they're diversified in so many different ways, and each has 50 to 100 stocks in it. So there's a hell of a lot of diversification. So how come we're not getting the returns? I'll tell you one of the key problems. Let's just look at Meta for a second and take it as a proxy for anything. This is from 2016, okay? So there are years when funds might get lucky, and even in a rising tide, they go up, obviously, as we've seen. most of them don't even do that. But let's say a few do. The biggest problem they have is when the market drops, as it did in 2022, they're going to sink you with it. Now, you might say, well, that's okay, Alpesh, because look, the market rises and they've protected me. At least I'm back to where I was. Well, as you saw just now, no, you're not. Partly because when it sank, there was no guarantee it would go back to where it was, and in most cases it didn't. Meta was an exception. And also partly because by the time you dropped 80%, many of them won't stick with the same stock anyway. I mean, it's lost 80%. And so they'll miss the gains as well. Now, that's not to say you should stay with a sinking ship in the hope it'll recover because you get a 0% return. It's to say that we need some methodology of getting out of companies. Now, probably the easiest, most scientific, most mathematical is if it drops X%, say 15%, you sell, say 50%. If it drops 25%, you sell another 50%, so you're out. Okay? That's one way to do it. It's very simple, not controversial, not open to discretion. 25% from the high, you've sold all of it. If it drops 15, you might have sold half of it. What about getting back in? Well, the way we do that with individual stocks is, unlike every single one of those funds, is, first of all, we're not racist. So we don't say, well, we're only going to pick Chinese companies or US ones, right? That's the first thing. The second thing is we're not going to ignore huge amounts of information. So we're not going to say, oh, we only look at growth companies. Actually, we need undervalued companies which are also growth, which are also generating income, have good cash flows, because we know all these things are important to future stock price movements. How do we know that? Well, a certain Nobel Prize winning laureate called Eugene Fama, for instance. Anyway, we'll look at all of those factors and tick all of those boxes. If you don't invest by doing that way and give it to these guys, you're screwed. If you don't invest by being able to tick all those boxes, you got a problem as well. Probably the easiest way then for you to do it is to make sure you've got some kind of exit strategy, and your entry has to be ticking those boxes. Okay, and if you can't think of an entry strategy which can tick those boxes because you don't have access to the data, you're not on the Great Investments Program, then just do an index tracker with an exit strategy of, if it drops X, I'll sell Y, such as 15% based on your risk appetite. Don't try and forecast the future. Focus on your risk appetite instead. Anyway, that's how they're destroying you, and they're calling it diversification. So next time you speak to your IFA, say, well, how come the diversification didn't give me any of the diversification benefits I would have expected when the markets drop? Well, because asset classes are increasingly correlated in a downward market. That's way above the head of your average IFA, who, don't forget, has to sit a 2-hour multiple choice exam to get qualified and regulated to give you advice on your pension. Shocking.